In the glittering heart of Manhattan's financial district, where glass towers reflect power and privilege, one man quietly convinced the world's elite that he possessed a secret formula for perfection. His name was Bernard Madoff. To presidents, philanthropists, Hollywood icons, and Wall Street royalty, he was not just a banker. He was stability itself. Calm, calculated, unshakably confident. And for decades, no one dared to question him. He didn't promise wild returns. That was the genius of it. While others boasted double-digit explosions, Madoff offered something more seductive: consistency, quiet growth, smooth profits, month after month, year after year, regardless of market chaos. When the tech bubble burst and portfolios bled red, his clients saw green. When global markets trembled, his statements remained serene. It was as if he alone had cracked the code of uncertainty. But perfection is suspicious. And in the shadows of Wall Street, whispers began. Madoff's rise was the American dream in its purest form, a lifeguard from Queens who built an empire. He founded Bernard L. Madoff Investment Securities in 1960 with a few $1,000s and relentless ambition. Over time, he became a pioneer in electronic trading, helping shape the modern NASDAQ exchange. Regulators admired him. Competitors respected him. The financial media quoted him. He wasn't an outsider gaming the system. He was the system. That was the first layer of protection. Behind the polished floors of his firm, a second, far more secretive operation existed. It wasn't advertised. It wasn't openly discussed. Clients were referred through an inner circle. Entry was a privilege. You didn't find Madoff's investment fund. Someone important introduced you to it. That exclusivity created desire. Desire created trust. Inside a tightly controlled office on the 17th floor, a small team processed trades that never actually happened. The illusion was simple and devastating. Investors handed over billions. Madoff promised he was executing a split-strike conversion strategy, buying blue-chip stocks and hedging risk with options. It sounded sophisticated, conservative, brilliant, but no independent clearing firm verified the trades. No outside custodian held the assets. Madoff controlled everything: execution, reporting, confirmation. He had eliminated transparency while convincing the world he was the safest man in finance. For years, financial analyst Harry Markopolos tried to expose him. Markopolos studied the numbers and realized something terrifying. The returns were mathematically impossible. Madoff wasn't just lucky. He was violating probability itself. Markopolos went to the Securities and Exchange Commission not once, not twice, but repeatedly. He handed them detailed evidence, charts, models, red flags. The SEC ignored him. That failure became one of the greatest regulatory collapses in American history. Madoff understood something fundamental about power. Institutions fear embarrassment more than they fear crime. To admit suspicion would mean admitting oversight failure. So they chose comfort. Meanwhile, the money poured in. Charities entrusted him with their endowments. Universities relied on him. Families invested generational wealth. Some clients gave him everything. Entire fortunes sat in his hands because his name alone had become collateral. Then came 2008. The global financial crisis detonated like a bomb across Wall Street. Lehman Brothers collapsed. Markets plunged. Investors panicked and demanded withdrawals. For most firms, it was a liquidity nightmare. For Madoff, it was extinction, because there were no real investments, no vast portfolio quietly compounding. The entire operation was a Ponzi scheme, the largest in history. New money paid old investors. As long as fresh capital flowed in, the illusion survived. But when fear replaced greed, the machine stalled. Billions in redemption requests flooded his office. He didn't have the cash. He never did. On December 10, 2008, in his Manhattan apartment, Madoff gathered his two sons, Mark and Andrew. For years, they had worked in the legitimate trading arm of the business, separate from the secret investment division. That night their father confessed. It's all one big lie. 17 floors below his reputation, decades of deception collapsed into a single sentence. The next morning, his sons reported him to federal authorities. Within hours, FBI agents arrived. The mastermind banker who had manipulated the global financial system walked out of his building in handcuffs. Calm, silent, almost relieved. But the arrest was only the beginning of the horror. When investigators peeled back the layers, the scale was staggering. Nearly $65 billion in reported account balances. An estimated $17 to $20 billion in actual investor losses. Thousands of victims across continents, pensioners, Holocaust survivors, nonprofit foundations that funded medical research. The damage was not abstract, it was intimate and devastating. Court documents revealed the simplicity of the fraud. There were no complex algorithms, no secret offshore trading desks, just fabricated account statements printed by aging machines, fake confirmations, backdated trades created after markets had already moved, ensuring perfection. It wasn't financial genius. It was psychological genius. Madoff understood trust better than mathematics. He cultivated an aura of humility. Soft-spoken, almost grandfatherly, he never flaunted excess. That restraint disarmed suspicion. While other executives chased headlines, he avoided them. Power without spectacle. In 2009, he pleaded guilty to 11 federal felonies, including securities fraud, wire fraud, and money laundering. There was no dramatic trial, no theatrical defense, just admission. The judge sentenced him to 150 years in prison, the maximum allowed. A symbolic statement from a system desperate to reclaim credibility. Yet even behind bars, the story refused to settle. Questions emerged. How could such a massive fraud persist for decades without deeper complicity? Did banks ignore red flags because they profited from feeder funds steering clients to Madoff? Why did regulators fail repeatedly despite clear warnings? Lawsuits rippled outward, targeting financial institutions accused of enabling the scheme through negligence or willful blindness. The scandal exposed uncomfortable truths about the global financial system. That prestige can replace due diligence. That exclusivity can silence skepticism. That regulators, overwhelmed and under-resourced, can miss what's hidden in plain sight. The personal fallout was even darker. Mark Madoff, his eldest son, died by suicide in 2010, on the second anniversary of his father's arrest. Andrew later succumbed to cancer after years of public scrutiny and anger. The Madoff name became synonymous with betrayal. Families fractured, trust dissolved. From his prison cell in North Carolina, Bernard Madoff granted interviews. He claimed he alone was responsible. He insisted his family knew nothing. Some believed him. Others saw it as one final act of control, protecting his legacy narrative even in disgrace. He died in 2021 at age 82, serving only a fraction of his sentence. But the consequences of his manipulation continue to ripple through financial law and regulation. Reforms tightened oversight, custody rules strengthened, auditing standards sharpened. Yet no system can legislate away human psychology. The real power of Madoff's scheme wasn't money. It was perception. He exploited the universal hunger for certainty in an uncertain world. Investors didn't just buy returns. They bought emotional comfort, and comfort is addictive. In retrospect, the warning signs glow neon. A tiny accounting firm auditing billions. Impossibly smooth performance. Secrecy disguised as exclusivity. But in real time, surrounded by status and authority, doubt felt impolite. That is how the mastermind banker manipulated not only accounts, but minds. He didn't hack computers. He hacked trust. He didn't infiltrate governments. He infiltrated belief. For nearly half a century, he stood inside the financial establishment while quietly undermining it. Not with violence, but with spreadsheets and silence. And perhaps that is the most unsettling truth of all. Because Bernard Madoff was not a rogue outsider storming the gates of power. He was welcomed inside, celebrated, elevated, protected by the very systems that later condemned him. The global financial system prides itself on sophistication, on models and risk assessments and oversight committees. Yet one man, armed with reputation and restraint, bent it to his will for decades. In the end, the empire collapsed not because regulators cracked the code, but because fear disrupted the flow of new money. The scheme did not implode under scrutiny. It starved. That final irony lingers. If the 2008 crisis had not triggered mass withdrawals, how much longer would the illusion have lasted? How many more billions would have vanished? How many more institutions would have tied their futures to a lie? The mastermind banker who manipulated the global financial system didn't need encrypted networks or offshore bunkers. He needed confidence, and the world handed it to him willingly. In the quiet aftermath, as victims rebuilt what they could and regulators rewrote rules, a haunting lesson remained. Systems are only as strong as the skepticism within them. When trust becomes blind, even the most advanced financial architecture can be reduced to paper. Bernard Madoff once sat at the center of global finance, untouchable and revered. Today, his name is a warning whispered in boardrooms and compliance trainings. But warnings fade. Markets rise again. New promises emerge. And somewhere, perhaps, another calm voice offers certainty in uncertain times. The question that lingers is not how he did it. It is whether we would recognize it if it happened again.